Greetings, Dwayne, CFRN. Today we are recapping May 4th, one day before Cinco de Mayo, S&P 500 E-mini futures. No secret, big down day in the market. Couple ways to trade a day like today. One way to trade it is if you were following our tweet last night, which said to consider being short below 1379. In other words, sell 1379 on a stop. You could have taken the easy trip and just rode this thing down for a 15-point drop. Actually, you got the 15-point drop completed here. We took a little hop and then sank into the close. And this right here, 1363/64, that was our lowest weekly trading zone for the week. As you recall, last week we finished the week 1 point below our highest weekly trading zone. Reversal this week, we're down at the lowest weekly trading zone. And by the way, the weekly trading zones do go out to CFRN partners every Monday morning prior to the open. Okay. All right, let's take a look at today and walk through it the way we do every single day. The first trade that was signaled, here's midnight Chicago time, May the 4th. The first trade to signal was a short, and because we use a 2-point stop, the trade was stopped out. And clear the screen up so you can see it. Okay, right there, 86.25 was the entry to the tick. The drawdown was 89. The short entry was here after midnight. The short entry is here, 86.25. And from 86.25, price pulls up to 88.75. So that's a 2.5-point drawdown. So for us, that means we got stopped out. Even though there was this beautiful downside move, we didn't get into it. Why? Because we only risked 2 points on one of these trades. And this drew down 2.5. So you're thinking, well, gosh, if I just used a 3-point stop, I would have got all that. Well, we use a 2-point stop for a reason. We never risk more than 2 points. Do we sometimes use aggressive risk management and tighten it up to 1 point shortly after we get into a trade? Yes, we do that. But we never slip the stop. We never risk more than 2 points. Now, I'm sorry to say, but price came back and gave us another short entry after being stopped out. It said go short at exactly 1384.75. Price pulled all the way up to 1389. It's almost 5 points. 4.25. And then it took off. So because we only risked 2 points, we missed all of this move to the downside, and we missed all of this move to the downside. Now let me say this. Today was jobs day. The jobs numbers were not good. Much lower than expected. We would never trade in front of that number. I've talked to you about this before on this video series. There are people who specialize in trading the news, trading the numbers. That is not our specialty. It's not what we do. We make no bones about it. This we could have been trading in pre-market. But when that news came out this morning, this job news, and that, I'm trying to see what time this came out. I have to check to see. It could be that we might have missed both of these, because it looks like this pullback here was at 6 a.m. Chicago time. Let's pull back here. 7:30 Chicago time. So that's two different. There may have been two different reports this morning. If there was news in either case, we would have just simply stepped aside. We don't attempt to trade the news. That's not our forte. Now, we missed all of this because we got stopped out here. Is there other ways to get into this? Sure. Come take the free trial. We'll teach you. The first entry that we get, or the next entry that we get, is to go short. And you know, if you were here, and if you didn't know about the news thing, or maybe this happened and there wasn't even any news, you just got stopped out twice in a row. What's your level of confidence to take this trade short? You took a short trade, got stopped, took a short trade, got stopped. This is where a lot of people fall apart with their trading plans, is they can't pull this trigger. Not a third time. That's why you have to have some level of comfort in the methodology that you're using to trade the markets. You have to be satisfied that you do indeed have a statistical edge. Because you could, in theory, not only go 2 times and get stopped out twice in a row, you could get stopped 3 or 4 times. Over this series of videos, you've seen that typically doesn't happen, but there's quite a few coming up here. So just hang around and I'll show you what I mean. Okay, the pullback entry, we're told to go short by our system at 1378.50, and price drops to 23 and a quarter. So 78.50 minus 73 and a quarter, 5 and a quarter points. Maximum potential. That's the most you could have gotten out of that trade, but probably not what you actually were able to take out of it. Okay, the next sell signal came right here at 75.75, and it dropped to 72. 75.75 to 72, 3.75 maximum potential. Okay, the next sell signal came right there, and price dropped to 1369.75. So 74 minus 69.75, 4.25 maximum potential. Yeah, you're getting it. 4.25. Okay. All right. The next sell signal comes right here. Now this one, system tells us that we need to sell the market short at 1372 to the tick. We have a drawdown of 1 1/4 points. See, the entry's at 72. Price continues to climb to 73 1/4. See that? So we had a 1 1/4 point drawdown in this trade, but that doesn't stop us out because we risk 2 points on every trade. That's right. So from 72 to here, right there, is going to be 69 1/4. Yeah. So 72 minus 69.25, 2.75 maximum potential. That one trade could be a day maker, depending upon your trading plan and how you roll. Okay. Wait a minute. I'm sorry, let's see. Yeah, our 2.75 was here. That goes right there. Let me make sure I got that right. 72 minus 69.25, yeah, 2.75. The next entry to go short is here at 71.50. Price drops down to 65.50. 65. That's 6 points. Maximum potential. Okay. Next signal is to go short right here at 68. About 3 ticks of drawdown on that trade. Price drops to 63.75. So let's go 68 minus 63.75, 4.25. If it seems too good to be true, just wait, it's about to get ugly. Alright? And it's only 11 o'clock in the morning. Okay, our next entry says to go short. Right there. Okay. Pull this out of the way for a minute. Right there. See the little line? I've already put the right there. I've already put the X because the market went the other way. Not only did it go the other way, it went the other way more than 2 points. So, stopped out. 2 point stop. The next signal says to go long. First long trade all day. It says to go long at 66.75. And it goes up to 68.50. $1.75. Now, on a down day like this, on a trend down day, taking a long trade, even though the signal is there, something you might give some thought to if you want to be in that trade. Did it go 1 3/4 points, maximum potential? It did. It certainly did. Okay, the next signal is to go short. And our system tells us sell 1366. Sell 1366 to the tick. We do. Price runs up to 68 1/4. So what happens? We get stopped out. Why? Because we never risk more than 2 points on one of these trades. We get another long entry right here at 66 1/4. Price moves up to 68.50. It's 2.25. 2.25. Maximum potential. Then we get another signal to go long right here. At exactly 1367. Price falls. We do not get another trade entry, although we drop all through here. We don't get a valid sell signal until we don't. Then the market closes for the week. And I showed you where it closed on an hourly basis right here at the lowest weekly trading zone, 1363/64. Okay. Now you might go, well, what's this little thing? I never saw that before. No, you didn't. And when that turned red, if you'd been selling, you would have caught this, wouldn't you? We'll talk about that another time. Let's walk through the market and just, this is a new indicator that was rolled out to the partners last night. It's called the bias indicator. Come take the free trial, we'll show you how it works. But it's not really a part of this video series. Alright, we got to count up how many times we got stopped out. There's 1, there's 2, there's 3, there's number 4, and number 5. Stopped out 5 times. 5 times 2 points per stop equals 10 plus 1.25. I add 1 tick of slippage for each trade that gets stopped out. Equals negative 11.25. Let me go over that again. 5 trades were stopped out for 2 points each. The S&P 500 E-mini futures are a very liquid market. You shouldn't get stopped out. I'm sorry, you shouldn't get slipped on your trade very often. But it, can happen. So, for the sake of fairness, I just factor in 1 tick of slip on every stopped order. Now, so we know what the negative is. Stopped out 5 times. 5 times 2 points per stop equals 10 plus 1 1/4. That's 1 tick per stop of slippage minus 11.25. Alright, let's add them up. We got 5.25 3.75 4.25 2.75 6 4.25 1.75 2.25 for a grand total of 30.25 maximum potential. $30.25 maximum potential minus 11.25 for our stops equals minus 11.25 19 points maximum net potential. Okay. If you've never watched one of these videos before, then you might be going, why does he keep saying maximum net potential? Okay. Let me show you. So in this trade right here, they went 5 1/4. Number one, you had to be there. Number two, you had to actually take the trade. And number three, you had to milk it all the way down to the last tick to get 5 1/4. Now, a lot of websites, when they mark up their trades, that's exactly what they do. They count that as 5 1/4. In good conscience, I can't do that. Number one, I don't know if you were here for every trade. I certainly don't think, well, if you're following the system, I hope you took every trade. But number three, I highly doubt that you milked every single setup for every single tick. So how do I reconcile that? How can I rectify that? How can I make that not maximum net potential, but realistic net potential? $19 divided by 2. That's right. I throw 50% out the window. Realistic net potential. $30.25 max potential. Stopped out for 11.5. That leaves 19 points maximum net potential. But because you're probably not going to be there for every trade, and if you are there for every trade, you're not going to get every tick out of every trade. So whack it all in half by 50%. 19 divided by 2 equals 8. You go, wow, that's a lot of trades to get 8 points. Okay, I don't disagree. Over here on the hourly chart, if you shorted 13.79, you could have got off anywhere you wanted on the way down because it headed straight down and gave you 15 points. But that doesn't always happen. Once the news was over, see, if we kicked these out, or at least this one out, that changes the numbers rather dramatically. If you got in on this first trade here, about 15 minutes after the market opens, you know there's bad news at your back, and maybe you grab a couple points here out of this 5, and maybe grab a couple points out of this 3, and maybe grab a couple points out of this 4 1/4. That's 6 points. You're done for the day. See, if you just took 2 here, 2 here, 2 here, that's 6. 1 here, 7. Here's a 6-point move. Maybe you took another 2 out of there. There's 9. But ultimately, do you run into some trouble? Yeah, you do. Okay. So, have I painted you a rosy picture? Nope. I painted you a picture of realistic and brutal honesty. This is what it's like to really trade. Okay? Not some hyped up, paint shopped version of what could be, might be. This is reality. If you want to see reality, if you have a desire to learn how to trade for a living, if that's something you really want to do, you want to roll up your sleeves, get busy, go to work, come hang out with us. We'd love to have you. Go to cfrn.net/apply. Not only will that enable you to come into the live trading room for the next 5 trading days, but you'll be given a link to download a platform with the indicators. You'll have live data for all the futures markets, from livestock to lumber to E-minis to grains to metals. You'll also have every currency pair. So if you like Forex, you can use what I've just shown you on the currency pairs as well, and also on the currency futures. So I hope you have a wonderful weekend. Thanks so much, and I hope to see you in the live trading room.